In this recording, we will talk about managing growth. In our discussion of financial planning, we learn how to estimate a firm's future financing needs through pro forma statements. In this session, we would like to establish a formulated linkage between the revenue, growth, and specific levels of external funding or external funding requirement. So I'm using the external funding need or external funding requirement interchangeably. They both mean the same thing. A firm can finance its growth in two different ways. First channel is internal financing. So the firm can internally finance through the retention of profits. Company generates, or the firm generates profits, plows back those profits or retains those profits and finances its growth. Second channel is external financing through equity or debt issues. So either firm can issue equity or debt. For various reasons, including issuing costs, firms tend to avoid external financing and strive to finance their growth through internally generated equity or additions to retained earnings. So most firms initially rely on internally generated funds to finance their growth. That's almost an instinct for firm managers, because external financing is expensive and often arduous. Therefore, a measure of maximum growth a firm can accommodate or achieve with internal equity is useful for managers for planning purposes. So every manager should have a rough idea about the extent of growth that they can manage or achieve without resorting to external financing. The rate of sales growth that the firm can afford only by mobilizing its retained earnings is referred to as internal growth rate. This is a new concept. This was not discussed in Higgins, chapter 4, but we will quickly move on to sustainable growth rate after defining internal growth rate. So the internal growth rate is the rate of growth the firm can afford without resorting any type of external financing, whether it's external equity or external debt. Under certain assumptions, if the firm grows at its internal rate of growth, it can finance its expansion of assets with entirely plowback earnings or retained earnings. So this is the rate of growth that we are talking about, that the firm can achieve or accommodate without resorting to external financing. Let's initially make a few simplifying assumptions. One is that the firms are reluctant to issue new equity because of a number of reasons. We are going to talk about these, but cost and also some informational cost that the firm might incur could be prohibitive, and as a result, the managers typically avoid issuing new equity. We are also assuming that the firm will be reluctant to change its dividend payouts, that is, its financial policy or distribution policy is not going to change during the analysis period. So let's define internal rate of growth analytically by using these assumptions. Let's assume that G% growth in sales at the same time require G% of growth in assets. This is a simplifying assumption, but it is not really a binding or limiting assumption. We can easily change this, and with a simple manipulation, we can bring a lot of flexibility about this. That is, the sales growth and asset growth does not have to be exactly the same, but let's make that assumption to keep things simple. So with this assumption, given that the firm has certain amount of total assets right now or at time t, a profit margin that is not expected to change, a sales level that was achieved at time t, and a retention ratio that is not expected to change. And under these assumptions, firms' external funding requirement from time t to time t plus 1 can be estimated by using the following formula. So external funding need is going to be incremental growth in assets. So this is actually as a result of G percent growth in total assets, we would need additional total assets times G much new assets, additional assets, or we can call this incremental growth in total assets from time t to time t plus 1. So essentially this is delta TA. And this will be financed through the new sales level. When the firm grows at a rate of G, the sales will grow from ST to ST times 1 plus G. And given the profit margin, we are going to generate a net income that is equal to ST times 1 plus G times profit margin. And we are going to retain RR percent of this profit, or this is the retention ratio. And this is actually the addition to the retained earnings at the end of the period T plus 1. So if the retained profits are less than the growth in total assets, we would need external funding to accommodate the new levels of sales. So this simply sets up the equation in this form. And if we target a level of sales growth where we will not need any external funding, we can set this equation to 0 and solve it for G to figure out the extent of growth that we can achieve in sales without resorting to any type of external financing. So simply rewriting the equation in here and setting the external funding requirement or external funding need to 0, we can create this equation right in here. So this equation tells us that assets will grow by this much, and then we will have an amount of financing that is going to exactly match it. So under these conditions, what's supposed to be the growth rate G? Let's solve this for G, this equation for G. And in the next slide, here we have a solution for G. So G is equal to sales times profit margin, which is equal to, actually this part is equal to net income, times retention ratio. That means this is equal to retained earnings. And on the denominator, we have total assets at time t minus, again, retained earnings, minus retained earnings. So by just a simple manipulation, we can actually rewrite this as G, that is equal to ST times profit margin times retention ratio divided by total assets. Simply, we are dividing both sides to total assets. When we do that, total assets in here turns into 1, and then we will have a total asset quotient both on the numerator and in the denominator in here. So since sales times profit margin is equal to net income, and net income over total assets is equal to return on assets, we can write this growth rate, let's call it internal growth rate, as return on assets times retention ratio divided by 1 minus return on asset times retention ratio. So simply, internal growth rate is the growth rate that is equal to return on assets times retention ratio divided by 1 minus return on asset times retention ratio. So if we grow at the rate of internal growth rate, the company will not need to issue any equity or any new debt. Simply, the additions to retained earnings will be sufficient to finance the change in total assets as a result of growth in sales. Now, from here, we are going to move on to sustainable growth rate, which has been the sort of main discussion of Chapter 4 in Higgins. In contrast to internal growth rate, sustainable growth rate is the growth that the firm can attain without issuing expensive external equity. So in this case, we are modifying the definition. We are not limiting ourselves regarding a debt issue, but we are limiting ourselves with a constraint where we cannot issue new equity. However, our new debt issue has to be at a level that is not going to distort the debt equity ratio of the firm. That is, the new debt issue has to be at a level that will not change the firm's leverage. So, from our previous equation, we learned that change in the retained earnings or addition to the retained earnings is equal to sales times 1 plus G, which is the new level of sales, times profit margin times retention ratio. So we are assuming that neither profit margin nor retention ratio is changing. So as a result, we will add this much into our equity. And in order to preserve the debt equity ratio, we should have an amount of debt issue that is going to preserve this debt equity ratio. So that means that we will have to add delta amounts of debt into our capital structure so that it satisfies this equation. On the denominator, on the numerator, we have new debt issue, and in the denominator, we do have addition to retained earnings or new equity. So this ratio has to be equal to debt equity ratio. From here, we can calculate the incremental debt that is going to preserve the debt equity ratio at its original level. That is actual delta debt times retained earnings times debt equity ratio. So this means that when we issue delta debt amount of debt, our debt equity ratio is not going to change. So sustainable growth rate is derived under the following assumptions. First, we are assuming that firm does not issue new equity. As we said, we are constraining ourselves with no new equity issue. We are assuming that firm does not change its dividend policy or retention ratio remains the same. And also firm does not change its debt policy or its financial leverage, meaning that it preserves its debt equity ratio as it was before. So if you rewrite the external funding equation under these assumptions, external funding need will be equal to the new addition to the assets minus the financing that comes from addition to the equity plus an amount of debt that does not distort that equity ratio. So if you remember, we described this as ST, which is the original level of sales, times 1 plus G, which is new level of sales from sales growth from ST to ST plus 1, at ST plus 1 becomes this amount. And we generate this amount of net income eventually, and then this is the retention times debt equity ratio gives us the amount of debt we can raise. So if we assume that with the addition to the retained earnings and this amount of debt that does not distort that equity ratio, we won't have any new external funding requirement. This means that we can set this equal to 0, and as is shown in here, and solve this equation for G. So we can rearrange this equation as TA times G, and as you see in here with slight reorganization, we can simply write this as retained earnings here times 1 plus debt equity ratio. And we can now solve this equation for G, and when we do that, we simply have ST times profit margin times retention ratio times 1 plus debt over equity ratio, and then in the denominator we have total assets minus ST times profit margin times retention ratio times 1 plus debt equity ratio. Now we're going to slightly rearrange this to have a better representation. If you remember, net income is equal to sales times profit margin. Net income over equity is equal to return on equity, and 1 plus debt over equity is equal to total assets over equity. We can rearrange the equation with these substitutions. So we will write the equation as we did before. Simply we are going to change 1 plus debt over equity into total asset over equity in here. We're going to do the same on the denominator, and then we will use ST times profit margin as net income. We will use this denominator E to define return on equity. So on the denominator we have simply return on equity times retention ratio times total assets. And on the denominator, we have total assets and then again return on equity times retention ratio times total assets. And once we divide both numerator and denominator to total assets, we get return on equity on the numerator and 1 minus return on equity times retention ratio on the denominator. Now, note that the equity that we are using in here is the equity that is at the end of the period. So this is equity at T plus 1. We are looking for a period from T to T plus 1. The profit that we generate, net income, is occurring between time T and time T plus 1. Our starting sales was ST. If you remember, we calculated ST plus 1 as ST times 1 plus G. So in all of these equations, total assets imply the total assets at T plus 1, and equity implies equity at T plus 1. So we are going to make a simple manipulation in here. So we will write return on equity as net income over equity at T plus 1 times retention ratio, and here 1 minus net income over equity T plus 1 times retention ratio. So this is another expression in here. And then we will do one more manipulation just to reconcile what we have in here and with the finding that Higgins proposed or presented. So with the sustainable growth rate as written as net income over equity at T plus 1 times retention ratio, 1 minus, again, net income over equity at T plus 1 times retention ratio, we could simply multiply both numerator and denominator with ET plus 1, and when we do that, the ET plus 1 here cancels out, and we have net income times retention ratio in here, and this is simply the retained earnings. And at the denominator, we have new equity at T plus 1, or the new level of equity at T plus 1, minus net income times retention ratio. Now remember, this is the addition to the retained earnings. So if you subtract the addition to retained earnings from end of period equity, we simply get the beginning of the period equity. So that means that sustainable growth rate in here is equal to net income over beginning of the period equity times retention ratio. So if you write this down like this, we get return on equity times retention ratio. This is actually what Higgins presented as the sustainable growth rate. So just to summarize, sustainable growth rate is the maximum rate of growth in sales a firm can achieve without issuing new shares or changing either its operating policy, which means we do not change our profitability and efficiency, and without changing firm's financial policy, which implies that we do not change the leverage or the payout ratio. So given these assumptions, what are the limits to a firm's ability to increase revenue? It turns out that it all comes down to a firm's ability to increase its internal equity. Since the firm has a given debt policy, it can increase its debt only if its equity increases, and even then only in proportion to the increase in equity. The growth of equity and debt limit the growth in assets, which in turn limits the growth of sales. So the sustainable growth rate depends on the growth in equity, which in turn depends on return on equity and the proportion of equity retained in the firm's retention ratio. So if you rewrite the sustainable growth rate in this fashion and open this up a little bit by using DuPont model, we get sustainable growth rate as a function of profitability, a function of firm's efficiency, a function of firm's leverage, and a function of firm's payout ratio. So dissecting the sustainable growth rate into these components also gives us some insights about how a firm can increase its sustainable growth rate, meaning that the type of growth that it can achieve without issuing external equity and without distorting its existing capital structure. A firm can always increase this threshold growth rate to higher levels by increasing its profitability, its efficiency, leverage, or reducing its dividend payout ratio or increasing its retention ratio. Now, of course, it is quite unlikely that a firm's annual growth rate will always occur at a rate that is exactly equal to its sustainable growth rate. But when there is a gap between sustainable growth rate and actual growth rate, this gap has certain implications. When a firm is expected to encounter such a gap, managers can take certain actions in order to close this gap, or maybe rescale the growth projections in order to prevent excessive funding needs that could have value destructive implications. So if the sustainable growth rate is lower than actual growth rate, the firm might increase its profit margin, might improve its efficiency, or change its payout ratio, reduce its payout ratio, and increase retentions to catch up to the actual growth rate. So, but of course, all of these have implications. Often firms have limitations in highly competitive markets to increase their profitability. The efficiency improvements also might not be easy to achieve, particularly if the firm is already operating with some level of efficiency. And also, increasing retention ratio might have implications. Shareholders might revolt to reduce dividends. So all of these will have to be thought out very carefully if the company is, or the managers are going to take action. Here is a simple analysis of the implications of the actual growth exceeding sustainable growth rate. One obvious implication of this is that when the firm has a growth rate that exceeds the sustainable growth rate, the company will have a funding problem. Partially, this funding problem can be accommodated by utilizing firm's excess cash, but that means that the firm is going to be reducing its cash levels. So, even if the firm has substantial cash reserves, high growth might consume the existing cash, and at some point, firm might face substantial needs for cash, and that would require external financing or maybe distortion of leverage. If the sustainable growth rate is exceeding actual growth rate, the firm might reduce its financial leverage, or it might return money to shareholders by increasing payout ratio. It might cut its prices and reduce profit margin. Or firm might acquire high growth companies to push up its actual growth rate towards sustainable growth rate. So these are the strategic options that the firm would have if the sustainable growth rate is exceeding its actual growth rate. Now, both internal growth rate and sustainable growth rate does not necessarily suggest a problem for the firm if the actual growth rate is not compatible with those growth rates. But the estimation of internal growth rate and sustainable growth rate provides an opportunity for the management to anticipate the implications of that growth in terms of funding need, in terms of its implication on its capital structure, financial policies, and operational policies. So I will stop this recording with this note, and we will reconsider this topic in the context of Dell's working capital one more time.